Hello everyone, today is October 8th and this is our first session of the tape reading special and series number 1. So we've got quite a lot of things to cover. I'm extremely excited about this course. It took me literally years, to say to myself and to our students that now I'm comfortable, to present this material in the way how I want to present this material, in a very systematic way, in a very detailed way. And also, obviously, I wanted to invite the specialist, people who've been doing tape reading for years and who I consider, one of the best in the world. And obviously, we know who they are, and some new introductions are going to be made. So it's going to be an exciting 3 months. It's going to be an exciting 10 sessions. So what are we going to cover? I'm going to go really quickly through this because you guys already know, you've seen this on the website. So we're going to start with the foundational principles. In the next 3 sessions, we're going to discuss basic to intermediate concepts. Specifically, we're going to focus on bar-by-bar analysis. That's kind of like bread and butter of tape reading. We're going to concentrate also on swing analysis that will allow us to understand the strength and the weakness of the price structure. We also will be doing a lot of contextualization of our tape reading techniques within the Wyckoff price structural analysis as well. And on the top of that, we'll quickly revisit what the law of supply and demand is saying, effort versus result being the main law for us, and then point and figure in volume tape reading, and then horizontal volume and price tape reading. We're going to do a lot of drills and exercises. Even today, we're going to have 3 exercises, and you're going to have a homework. And I'm not even sure if we're going to be able to cover all of the material today, so you might actually have more homework. By the way, how's my audio, guys? Can you hear me? If you can't hear me, then just log off, log in back. All right. So what are we going to do next? Well, for those of you who are attending series number 1, or you signed up for the whole program already, you will receive a bonus session. It's actually going to be live, and that is with our own adjunct professor, Gary Follett. And Gary volunteered a free session for us on October 29th from 3 to 5 p.m. Pacific. And he's going to be talking, and I highly suspect that this is also going to be about the PNF and volume tape reading, as he's trying to tape read without any time frame constraints. And we know that it's only the PNF chart that is going to give you that type of no time references. Series number 2, well, this is something very special. This is something that I want you all to be a part of. David Weiss is going to join us for the tape reading course, also for 3 sessions. We are going to have him for an hour and a half. There's some limitations that David has that we have to honor. And what we're going to study together with David. I'm going to go with him through intermediate to advanced tape reading concepts, and we're going to start with the original work by R.D. Wyckoff. We're going to show you such an amazing couple of charts, where the PNF is being combined with the volume, but not in the way how you would think about it. Then we're going to go through some of the explanations, and specifically he will talk about his wise wave indicator and his cumulative wave. So we'll put on some charts because we're going to look at some of the numbers there. He's going to tell us how to interpret those and what kind of deductions we could make out of that tape reading. Swing by swing analysis and bar by bar analysis is always going to be a part of that type of work. And as always, we're going to have exercises and drills for you and homeworks. Now, there is something very exciting about this particular series because now I'm teaching with somebody. So this series number 1, I'm teaching by myself, the basics. I just want to establish a really good foundation for us moving forward. But together with David, it will give us an opportunity to actually showcase some of the tape reading techniques and chart reading techniques. So I'm going to become a student of David, and David is going to give me a chart that I have no idea what that chart is going to be. And then I will try to tape read, chart read, and decipher what kind of bias, timing, and put on some of the trades. So we'll see how that's going to go. That's very exciting. Series number 3, I'm introducing to our community a new face, a new name, William Riordan. This is the talented tape reader who is residing in the UK. I had to connect with him, just finding him on Twitter, and then later on connected with him, and kind of went through a couple of sessions of exercises just to make sure that the level of what I've seen on Twitter corresponds to the level that could be taught. And yes, indeed, it's there. So I was really pleased because it's I've been on the mission this year to find the best tape readers in the world. Not the ones that are traders, but the ones that are teachers, the ones who could actually systematically teach us how to correctly apply these techniques. And William is definitely one of them. What are we going to cover? Some intermediate to advanced tape reading techniques. Those are going to be based predominantly on intraday and swing trading. That's his time frame. And he's trading a lot of futures, so we're going to spend a lot of time going through E-mini futures, intraday, into the short-term swing time frames. He's going to talk about the tape reading using multiple time frame analysis. And as with David, I'm going to become a student of Williams, and Williams going to put out a chart for me that I'm going to tape read and chart read. And again, that will be a very interesting task. We'll see if I'm, up to that. Drills and exercises and homeworks are always a part of our Wyckoff Analytics classes. I just cannot imagine that our classes do not have homeworks for you guys. So with that, let's just set out the intention right away. You are here for a specific reason. It's a really good reason. You want to improve. The way to improve is not just to observe and to listen, but to actually participate. And you could participate silently, meaning that as we go through this material and I'm asking the whole group a question, you should be answering this question in your head. That's number 1. More active participation. You have your questions box where you could type in any questions, any comments, any answers. I will be asking you a lot of questions today as we go through the exercises. I'm not going to volunteer people. That's not my intention today. But I will be asking you, and I would be expecting that for those who's going to be very interactive with me today, type in fast because we don't have a lot of time. So I want you to be focused. I want you to be on cue when I'm asking you any questions. And with that, let's just go to our material. And before we do this, what are we going to cover in series number 1? So here's the whole curriculum that I've developed for this series. We're going to start with the supply and demand at effort versus result. Today we're going to start and we'll devote the whole session to bar by bar tape reading. We'll talk about how do we describe the bars and their volume signatures. That's going to be the basic definition that you will have to know by heart in order for you, to start seeing those things on the charts. Obviously, I mentioned exercises. Those are going to be, throughout the whole session today. We're going to talk about how do we contextualize bar by bar tape reading. We also will talk about the usage of analog bars. How do we find those and what kind of deductions we actually make out of those analog comparisons? And then obviously homework. As we come back to session number 2 next Thursday, we're going to review the homework. I still don't know in which shape or forum we're going to do this. It just depends on how much material we're going to cover today. It could be a self-review, or it could be just, some of the questions that if you have questions and I see the validity of coming back to those questions, we'll do that. Next Thursday, the basics are going to be on swing by swing tape reading. And we're going to figure out how to compare a rally to a reaction, how to compare a rally to a rally, and then a reaction to a reaction in different market environments. So context is always going to be on our agenda. And, we're going to look at the characteristics of the swing, the price extension, the volume signature, the texture with which the price and volume behaves on those swings. Exercise number 4 is going to be on just tape reading the swings. Then we're gonna dive into the context. Actually, this should be swing by swing analysis. Apologies. Then we're gonna do another exercise on swing by swing analysis, applying the Wyckoff price structures. Then we're gonna deconstruct the swing. So this is also gonna be very important. We need to understand how what the swing consists of. What kind of elements, what kind of legs up and down. And then we're gonna also do the exercise on the analogs. Homework as usual, and then we'll start session number 3 with the homework review, and then the rest of the material in session number 3 is going to be additional foundational knowledge, other ways of how we could improve on seeing specific elements of tape reading and what we could add to our analysis. That would be a PNF and volume, and we'll do some exercises on that. We're gonna look at the horizontal volume signatures and how that interacts with the price and how we could tape read that. That will be another exercise right there. And then we're gonna go into some case studies. We're gonna talk about the synchronicity of the reversal, extremely important concept. I put it as a law number 5 in Wyckoff methodology. We're gonna tape read the momentum. So this is a very interesting skill. So this is something that usually, because we used mostly indicators and at Wyckoff Analytics we usually don't, but we use that like in scanning, we use this in other analysis, but usually I would force the students to start seeing the momentum with the naked eye, meaning that without any indicators, can you identify whether momentum is increasing or decreasing? And we'll talk about what kind of practical exercises on tape reading you could do by yourself at home after the completion of this course. And for the fun of it, we're going to do our market analysis in session number 3 using our tape reading techniques. I will be expecting that starting with, this session, you could email me any questions. Now, I most likely will not answer those questions in session number 2. I just want to make sure that we go through all of the material that we need to go through. So all of the questions are going to be addressed in session number 3. So, start sending those. And obviously, some of the answers will be given later on. So if that answer has been given in session number 2 and you sent the question prior to that, I'm going to disregard that just because we are not going to have a lot of time. And then homework number 3, I'm going to give you the homework and then I'm going to give you the solution on the class page. If there are any administrative questions that you have about this particular series or the whole course that we're going to conduct in the next 3 months, please email us at wyckofassociates@gmail.com and ask our Chief Operating Officer Nancy any type of questions. Those could be related to access information, webinar links, payments, and so on and so forth. All right. And by the way, one last announcement. So today, even though we are saying from 3 to 5, we could go slightly beyond that. And for those of you who are my students, you guys know this. There's just too much material, and I'm just the teacher who just want to make sure that you guys, get this, and therefore I want to go through all of the potential, questions that we have about today's material. Sam is asking, will this session recording be available along with these slides? Yes, absolutely. This is how we do this at Wyckoff Analytics. All of our sessions are recorded. They will be all of those recordings together with slides in the PDF format will be put on the class page. The email with the access information to the class page will be sent to you tonight, probably around between 8 and 9 p.m. Pacific. All right, well, let's talk about the basics of tape reading, and we have to start with very elementary uh, laws that we have in Wyckoff methodology. Law number 1 is all about supply and demand, and law number 2 is about effort versus result. Okay, before we do this, a couple more questions. What is the best email address to use for the course-related questions? Wyckoff Associates at gmail.com. Next question. Any chance you can post the slides before the session? From Arvin. Arvin, you are our student. You know better than this. I don't do this, and that's very deliberate just because there are a lot of solution slides that I put in. And also, I've done this at Golden Gate University where I would give the slides to students and then they would be consumed by the slides and not even pay attention to what I'm saying. So I don't teach this way, and therefore the slides only going to be presented to you after the class. How long are the class pages available after the completion of the class? From John. So usually we have a 1-year access for you guys upon the completion of the course. So we're going to finish in December. For those of you who are taking only this series, we're going to be finished by the end of October. So a year from that, that's the time for you to go to that page as many times as you want, to listen, to watch the videos. I am just not a believer of a live access because I think it's the most unmotivational tool for students when they have the live access. So it's kind of like, yeah, I can put this, on the back burner and just, attend to this in a couple of years. No, you will not, just because if you are not going to do this right now, you will not do this later on. So I'm just not doing that type of thing. But after a year, you could definitely, renew your access for a nominal fee. And, if you want to repeat the course after a year, for sure. All right, let's talk about effort versus result. Let's talk about supply and demand. So supply and demand is a very, simple law that we have in the Wyckoff methodology. And the simplicity of it is that if there is more demand, we would expect the price to go up. If there is more supply, then we would expect the price to go down. So very, very simple. The complication comes with the second law, the law of effort versus result. But at the same time, this law is actually almost not only inclusive of the supply and demand law, because this law is just basically talking about, a price and volume being in harmony when the effort is increasing and the price is increasing as well, or effort is increasing to the downside and the price is decreasing. So that's a harmonious existence, between the effort and the result. What's important about this law is the disharmony between the effort and the result. What if the effort increases, let's say to push the price up, and yet the price does not go up? What does it mean? Well, it means that there is an opposing force. In the case of price rising, an opposing force will be supply that comes in and stops the price from moving further up. The same we could observe, the same disharmony or divergence we could observe if there is an attempt to increase effort to push the price down, and yet the price does not go down. So what does that mean? That means that the opposing force in this case is going to be demand is present, and that stops the price from moving further down. For instance, here is this example where in the established context of an uptrend, we are seeing how the volume signature increases. Whenever volume signature is going to increase, we're going to say that the effort is increasing as well. So if the prior effort was like this volume signature, then now effort has increased. So we are trying to push the price down in this reaction, and yet, and therefore we're going to say a downward effort is increasing and increasing substantially when there is a volume spike right here. And yet, what happens with the reaction? The reaction seems to be of the same magnitude as the previous reaction. It doesn't extend as the reactions that we see in the trading range formation. So therefore, we are going to say downward effort is increasing, yet what is the downward result? The downward result is not increasing. It's the same as the previous reaction. So we're going to say it's not increasing, it's actually decreasing. The decreased result on increased effort in the uptrending environment would suggest that there is a presence of demand that is expanding and that is absorbing supply. And that would suggest, if there is an absorption of supply, that would suggest a continuation of an uptrend. And that's a basic logic behind the law of effort versus result. And we could reverse this and just say, for instance, let me just quickly see, for instance, this area right here, and I would have to figure out exactly the bars that correspond. What do they correspond? Yeah, so this is the law probably. Okay, so then the next two bars, look at this. The next two bars still have a relatively high volume signature, and then they still going up. But if we would take this spread right here, and this is where the daily spread is contracting relative to the spread, the daily spread that we've seen, on the prior day. But the volume signature is the same. So effort stays the same, and yet the result upwards is diminishing because of the spread. What does it mean? There is some presence of supply. So there is divergence between the effort and the result. And this is the opposite of what we've seen in this area right here in the uptrend. What does this suggest? This suggests that supply is present and we could have some kind of reaction and reversal. So therefore, there's going to be some kind of continuation of a decline. All right. Don't worry if this is something new to you and you still have to get used to this. For now, just take this knowledge for what it is, and we, as usual in our classes, is going to repeat the same concept over and over and over again. And by the end of these 3 sessions, I guarantee you, you will understand and you will be able to see this concept on the chart. And if you can't, contact me and I will go with you individually, through that particular concept. But definitely, don't contact me just, with any type of questions, because that would just be a little bit too much. Okay, so how would we be describing effort? How would we talk about the effort? We would just have in our abbreviation letter E for effort, increase of effort, decrease of effort as the increase in volume from the previous volume signatures. And usually we would look, let's say if we're looking at the update, we could look at the volume of the previous update that comes maybe on the same rally or maybe on the different rally. If we look at the volume increase or decrease for the down days. We're gonna, down day, we're gonna find the down day that comes prior to that. We just want to assess whether the effort on the demand side increases or whether the effort on the supply side increases, and how the price actually behaves with that increase or the increase in effort. If we are going to have extreme effort increase, we're just going to do this, and then upward effort is going to be a smaller U letter before a capital E, and the downward effort a small D letter in front of E. And this is just semantics, so this is not as important, but as we go through the exercises, it's going to become to you very evident very quickly that it's just an easier way of abbreviating what exactly we want to say. What about the result? Well, the result is a little bit more complicated because we want to not only understand how we abbreviate and how we show the increase or decrease of the result for the up bar or for the down bar. We also, and this is extremely important, we want to understand how we are measuring the result. And we're going to measure it by three things. We're going to measure it by the increase or the decrease of the spread. And don't worry about the definition of the spread right now. We're going to cover this in the next couple of slides. And we're going to talk about the spread as a bar spread, and we're also going to talk about the true range. So again, we're just going through the basics right now. But we want to understand on the result side, does the spread increases or decreases? We also want to understand the situation with the close. And with the close, we want to understand two things. How's the close behaves relative to the actual spread of the bar? Are we closing in the upper part of the spread? Are we closing maybe above 75% of the spread? Or are we closing maybe into, below 1/2 of the spread? So those are the definitions that we're looking for in how we analyze the close. The second point of analysis from the close point of view is going to be, how does the close to close behave? So meaning that from the previous close to the current close, and then to the next close, and then to the next close. We want to see the progression of the price movement based on the close and not just on the highs. That would give us an understanding of the momentum feature in tape reading, and also would suggest some kind of shortening of the thrust or expansion of the thrust. But with all of that, if I would be looking at the spread and the close, I would say that those are just characteristics of the result. But what I really would like to extract from the picture is the intention, or rather, was the intention satisfied behind the movement of the price? Have we overcome a significant resistance or support level that was in front of the price, that was in front of the current price? And if we are going to say no, then even if characteristics could be bullish, but the intention was not satisfied, we're going to say that the result was diminishing. If the intention was satisfied, then we obviously would say that the result was expanding. Let's talk really quickly also about the volume spike. So this is very important because a lot of you, ask this question almost right away when I talk about chart analysis, tape reading, or just, structural things. Where do we see volume spikes? Well, here is one, here is another. There is a bunch of volume spikes right here. There's a small one here. There's a big one right here. So we're going to have up spikes and down spikes. Up spikes are going to be on the bars that are gapping up, that are moving up, and down spikes are going to be, on the bars that are actually moving down or gapping down. Now, in the case when we have the bar that has a big volume spike and the price goes up, volume is increasing. Demand is increasing as well, and demand at that point is going to dominate the supply. That's what we're going to say, and that's how we're going to, put this in our volume equations. But at the same time, because of that volume spike, there is always the presence of the opposing force. And not only that, the opposing force on the volume spike is always going to increase relative to what it was before. So for instance, if we're looking at this bar right here, and we would be comparing it to this bar, which both are down bars, but this one is the volume spike. And with the volume spike here, we're going to say that because this is a bar down, supply is going to increase and demand is increasing as well. And because demand is increasing, we would be expecting some kind of stopping action, maybe some kind of change of behavior, potential trading range. So all of those things are going to be present if the opposing force is increasing relative to what it's done before. So look at this supply level and then look at this big bar. So it's not just supply alone on that reaction. It's actually demand as well. And I'll show you other ways how to identify demand on those type of bars that have that big type of volume spikes. All right, let's go further down the road. Let's talk about the description of bars and volume signatures, and then if you guys have any questions at this point, this would be a good time to ask after we go through the next 3 slides before we start doing the exercises. I want to make sure that whatever material I'm giving you right now, even though it's basic, but it's understood, and we feel comfortable about that. All right, so this is actually the material of the Wyckoff Trading course. For those of you who are not familiar, this is our flagship course. It's a 15-session series, so go check it out if you haven't taken this before. It goes into such depth of the Wyckoff methodology and is a foundational course as well. Let's look at the bars, and I'm usually using candlestick bars, and usually there is a question, why do you use candlestick bars and not vertical bars, just irregular bars? Well, candlestick bars are a little bit more visually telling. They just show the body in much faster way. You see right away that it's an up bar by the color. That's number one. You could see the expansion throughout the whole bar or decrease of the spread throughout the whole bar. So it's just a little bit visually pleasing to me, and I'm just kind of used to that. Do I use candlestick patterns? I do not use candlestick patterns per se, but the tape reading is all about those type of patterns. So if you tape read, you should be able to understand candlestick patterns very easily. Well, let's go through this example, and this is a theoretical example. One of the tasks that I want you to understand and to go through is to understand what the spread and the true range is. So this spread, whether this is a daily bar, whether this is a 1-minute bar, whether this is a yearly bar, is going to be the difference between the high and the low. So we're going to say that this distance right here is our spread. And obviously the bar is going to consist of 4 major data points for us: the low, the high, and the open and the close. And if the close is above the open, we're going to have a green bar. If the close is above the previous close, we're going to have a green bar. In some softwares, if the close is below the open, you might have a still bullish day, but you might have a different color. Sometimes I see, like on stock charts, for instance, like a black color. It shows to you that it's a bullish bar, but the close is below the open. Well, this is just a small nuance, so let's continue. Whenever we have a gap, that's when we are getting a little bit into trouble with the definition of the spread. There are 2 types of gaps for me: the ones that are being covered And by being covered, I mean literally on the next bar, not in a year, not in multiple months, but on the next bar with the intraday action. So here we see that the bar opened with the gap, and then there was an attempt to go down intraday to the low. That's what created the low. And then the price went up to the high and closed into these slightly lower level. So we could see this, and I put for you here the intraday action. First the gap, then the open, then the first move down into the low. Then there is a lot of demand and it carries us up into the high, and then into the close we see some profit taken. So with this type of covered bar, we don't have to worry about the definition of the spread. We still, because the low actually goes below the close of the previous day, and we are covering this gap, the spread is going to be defined as the high, the difference between the high and the low. So still the same thing as here. Now the trouble that we get into comes later on when we actually start seeing the gap that is not covered on the next bar. So how do we define the spread? Well, there are two definitions of the spread, or rather two definitions, the spread and the true range, that we have to remember here. The definition of the spread, let's say if this is a daily bar, is still going to be the movement of the price during the day. And that means that we're going to have the high for the day and we're going to have the low for the day. And that would be by us defined as the daily spread. The true range is something different. The true range is the difference if we have a not covered gap. It's the difference between the previous close and the high if we're in the bullish scenario here. So this whole distance that the price covers would be considered a true range. The high minus the previous close. And you might be asking, why do we do this? Why do we need a true range? What's the logic behind it? Well, the logic is very simple. The bar is actually bullish just because we have a gap and we still have continuation during the day to the upside. But during the overnight price action, and this is why the gaps happen, there is some kind of institutional buying and exchange of shares that is happening. And institutions are marking up the price in the overnight action into the open on the next day. So could we say that this is an opposing force? No. It's in line with what the bar is actually doing. So therefore, we're going to say that the true range for this bar with the overnight price action was the difference between the high and the previous close. And then again, just one of the skills that I require our students to have, especially as you guys go through the WTC course and the practicum, is to understand how you could extract the intraday data from your daily bars. Because and obviously it's a rough approximation, but at the same time, it's a very, very useful skill to have to understand by looking at the bars what is happening here and how the price unfolded during the intraday. All right, let's look at the different environments. So now we're looking at the downtrend and the down bars. Again, this spread is going to be defined very easily. It's the difference between the high and the low. And look at this very interesting bar. It has this, what we're going to call a supply tail. A supply tail meaning that there was some selling on the way down and supply most likely has increased. So how would that look on the intraday? Well, one of the possible scenarios here is the open attempt to go up into the high, and then supply comes in and puts the price down, and the low is below the open and the close is below the open. So your body is going to be the difference between the open and the close. It's going to be bearish because the close is below the open. And then you're going to have a tail on both sides, and your supply tail is going to be uh, above the open. If we are going to have a covered gap, the spread is going to be defined, in the same way as everything else. We're going to be looking at the difference between the high and the low. There is nothing, for us to think about here. But once we go into the not covered gap, then we have to extract the true range, and it's going to be the distance that the price travels from the previous close throughout the overnight action and then into the low. That's going to be our true range for this bar. And again, it's going to be very important because the look of the true range bar is different than, let's say, the spread of the daily bar. So I just want you to remember this. Okay, now let's talk about how do we interpret the price and volume bars together. And that's what the volume and spread analysis is all about. One of the main ideas that is extremely important, and throughout all of the classes, including WMD classes on Wednesdays, I emphasize that if you're using VSA, the volume and spread analysis, you need to understand and define the context of where you have your signals and where they come. Do the same signals come in the uptrend and, let's say, in the non-trending environment, consolidation? And what would they mean? They would mean different outcomes, different meanings. So we need to contextualize our VSA signals. Well, we're going to start with something, again, very simplistic. And again, this whole session today is all about basics. So what do we do here? We're going to look at the very basic definitions of the spread and volume. And this work actually was done by Jerry Blythe. He was one of the students in Hank's classes at Golden Gate University, and this is, his work. So I just want to give him the kudos and give the kudos to Hank. This is where, it all kind of like started. So Jerry gave us a little bit of the synopsis as to how he was looking at the spread and volume in general. So if the spread is increasing, there is really nothing that is going to stop this the movement of the price until we have the opposing force increasing. If the spread is decreasing, there is some resistance to price progression. And if the spread is average, it's just a normal trend action. So very simple, very understandable. Volume is going to be a slightly more complex because usually volume is going to be associated, and I love this expression, it's being associated with the force of power behind the move. And whenever we talk about effort, we actually mean increase or a decrease of that force of power behind the move. We mean the increase or the decrease in the volume signature relative to what that effort was before for the up bar or for the down bar, for the upswing or for the downswing. And you kind of already could see where I'm going with this. If the volume is increasing, most likely we are talking about some kind of change in the supply and demand relationship. And usually I tell my students that you have to think supply first and then demand. And it's just going to be extremely important to understand that supply is something that institutions either observe or they distribute supply in the marketplace. So therefore, whether they are buying it and locking it down for the duration of the trend, or whether they are distributing and the supply becomes available in the distributional formation, supply is of utmost importance to us. And then we could think about the demand. If the volume is heavy, that usually, again, would indicate the supply. There are some spots where we could, see heavy volume signature, and that could indicate the opposing force coming in, right? So for instance, on the reaction, in the uptrending environment, if we see a heavy volume, we would suspect that there is some demand there and there could be some stop in action in the reversal. We also would be expecting that the increase of the volume signature could come in the areas of the breakouts where we have some jumps across the creek, or we are jumping above the resistance, we're jumping on news, let's say some earnings and so on and so forth. Still, even with that, there is always an opposing force that is going to be present, and that's going to be increasing on the heavy volume signature, and especially on some kind of massive volume signature, that we would say that that signature is climactic. If the volume is decreasing, then there is some kind of deterioration of that force, and we could expect a reaction or a rally which is counter to the main trend. And then obviously, if the volume is very light, it's either a little push or supply is present. I would actually say that's I would take this out. So just a little push and a poor demand or poor supply that could be make us vulnerable to any type of the reaction. Well, this is all good, but we're talking about the spread in volume in different, without any context and without combining them together. So let's just look at the combination now, where we are using the spread, where we're using the volume signature, and where we're defining the context. And then we want to understand what the effort and the result is doing. And we want to also understand what kind of volume equation or effort and the result equation we would have. So let's look at this first slide, and the most important information on this slide is right at the top. We are in the advancing market. So let's just remember that. So the context is the uptrend, the spread is increasing, and the volume signature is increasing as well. Please note that this volume increase is actually, quite normal. So there is no abnormalities in the way how the volume signature increases. So we are seeing the increase in effort, and we are seeing the increase in result. Volume is increasing, demand is increasing, and in this case, we would be saying that supply is decreasing. Supply could be decreasing just because absorption has happened before, or there is no availability of the supply through this particular price level, and therefore just demand comes in and pushes the price up. So when the effort and the result is increasing this way, it's definitely a bullish picture. Second scenario, we're still in the uptrend. Now in this case, the spread is decreasing, and the volume is actually increasing. So we are increasing the effort to push the price up, and yet we are receiving a decreasing result. Why would that be? Under what circumstances that would happen? It only would happen when the opposing force, which is supply in this case, is present, and not only present, but increasing as well. So therefore, when, we still would say that demand dominates the supply in this case, but because supply is increasing, we could expect some kind of stop in action, maybe a reaction, reversal, maybe even a trading range, change of behavior. So we are expecting some kind of vulnerability and maybe some attempt to stop the uptrend and reverse. So some bearish outlook right there, unless we can overcome it. Third scenario, uptrend. Now in this case, we still have a decrease in spread, but now instead of increasing volume signature, we have a decreasing volume signature. So the effort is decreasing and the result is decreasing at the same time. So we know that with the decrease of the effort, demand is going to decrease for sure, And then supply could act in a different way. It could decrease, it could be the same, it could increase slightly. So therefore, we would be saying that there is some kind of vulnerability to a reaction that we could expect at this point. And therefore, our outlook here is going to be more bearish than bullish. Next scenario, an uptrend again, spread is increasing and the volume signature is decreasing. So decreasing effort, increasing result. So let's think about the demand and supply. What's the relationship here? Volume is decreasing and we are going up. So demand is decreasing and supply is decreasing at the same time. And on that background, we are making new highs. So therefore, there is some kind of ease of movement that we observe where the price on the diminishing demand characteristics could overcome specific levels of the resistance and commit above them and stay there. So that would mean that an ease of movement is underway and we are bullish in this scenario. Next scenario, last scenario for the advancing market. An uptrend, increasing spread, increasing volume, but it's a massive effort. It's when you have that volume spike. And remember what I said at the beginning of the session when we were looking at the effort and the result. Whenever we have those volume spikes, there is always the presence of the opposing force. And therefore, there is a vulnerability to stop, to reverse, to produce a change of behavior, and then go into a different environment. And usually those massive volume signatures are going to be climactic in nature. They could be the terminal climax, but in a lot of cases, those could be just temporary stopping actions going into, let's say, a reaccumulation or a redistribution. And they could happen on some kind of events and so on and so forth. But usually suggest stopping. All right, let's go to the next slide. We're almost done with the basics. Let's now look at the declining market. And we really, again, have to remember what the context is. So the context is a downtrend. On the increasing spread with the increasing volume signature, where the effort is increasing and the result is increasing, and everything looks normal, the way how the price expands and the way how the volume expands. We know that supply is dominating the demand and that demand is diminishing, and that is in line with the downtrend and is still bearish. In the next scenario, which is still downtrend, decreasing spread on the increasing effort suggests that effort is increasing and we are seeing the decreasing result. So what is this? What is happening on this bar and with this volume signature? There is no progression to the downside in the same manner as the previous bar. So there is some resistance that demand is providing as the price goes down. So therefore, demand is increasing, but supply is still there just because the volume signature is increasing. So therefore, there is some kind of vulnerability to produce some kind of rally. It doesn't mean that we're going to reverse and just, the downtrend is done. What I want you to remember is that we would need to understand that the reversal needs to happen and confirm itself. And the change of behavior needs to happen and reverse the downtrend. Somebody is asking, Joseph is asking, but how do you establish the context? Well, that's a science of its own, right? But, the definition of the trends, the definition of non-trending environments, those are very kind of rudimentary Wyckoffen tools, and we study those in the Wyckoff trading course. So for those of you who would like to study those in more details, please refer to that material. I'm just going to give you the definition, of the environment right away, so you don't have to think about it as we taper it. Or we'll just do small pieces of analysis, and you'll see how I define the environment, the context. All right, next scenario. We have three more, and then we are done with this with the basics. Uh, Downtrend, decreasing spread, and then decreasing volume signature. So still, that is suggestive that demand is there, and it could be in different shape and form, right? It could be decreasing, it could be the same, it could be increasing, but supply is definitely is losing its power. So selling is less evident, and therefore there's some kind of vulnerability to produce a rally. Next scenario, we're still in the downtrend, and with the increasing spread and the decreasing volume signature. So very interesting scenario where both supply and demand is decreasing, and the price falls under its own weight. And if we have the commitments below the areas of the support, we're going to say that this is an ease of movement, a very important Wyckoffyan concept that again, we study in details in the Wyckoff trading course. And we'll definitely go through this, so don't worry about if you're not familiar with the ease of movement. I'll devote some time to that. So here in this scenario is still bearish just because there is no demand that is present. And with the smaller supply, the price actually could go down. And the last scenario, like last interpretation, still in the downtrend, spread is increasing, volume is increasing, and there is a massive effort that is shown to us in the volume spike. So what does it mean? It means that there is demand that is trying to stop the downtrend, and there is some buying. Well, and whether this stopping action is going to be an intermediate selling climax or it's going to be a terminal selling climax, we would have to see, through the prism of our Wyckoff price structural analysis. But it's most definitely that demand is present, and at least at the minimum, that increase of the demand would dictate that it will try to stop the price from going further down, and therefore will produce some kind of reversal or the reaction up. All right. Well, let's see, guys, what kind of questions we have on this material. So I was trying to go through this really quickly. For those of you who are not familiar with this material, please go through this again by listening the recording. Stop the recording at the places where you feel that maybe you're gonna you need more time to spend on those concepts. Making notes actually help a lot, so I would fully expect you to do that. Stefan is asking, what's the difference between scenario number 6 and scenario number 10? It's all in the volume signature, right? So it's all in the degree of the increase of the volume signature over the previous instances, over the previous bars. So we could see that in instance number 10, we are seeing a massive effort to push the price down, which is basically different than what we have had in scenario number 6, and that's the main difference there. Okay, what else? Jeremy is asking, regarding volume spikes, I assume it's in the context of the time frame of the trade setup. Is this correct? Well, the volume spikes, obviously are going to occur, throughout. So we will have to look at the context of where it happens, right, Jeremy? So, for instance, if the volume spike happens, let me just draw this. Let's say we are in the trading range, and we could have different volume spikes. So let's say a volume spike here in the context of the stopping action of the downtrend would mean one thing. This is a stopping action for the downtrend. The volume spike, let's say in phase C, would mean somewhat the same, but from a different environment. If we were in the downtrending environment, In phase C, we are in the consolidating environment. And that volume spike and let's say the price reversal would mean somewhat of the same, but very nuanced price action, which slightly differs from the selling climax. We could also have the volume spike, let's say on the sign of strength bar, on the sign of strength rally. So that's a different context for those volume spikes. We could have the breakout going into phase E that also could have that spike. It could come on earnings. So again, contextualizing what we see is going to be extremely important and crucial for us. A question regarding the extended hours trading. Is it institutional or retail selling depending on which asset, for instance, Tesla or E-mini? So from Arvind. Usually the extended hours are just professional hours, even though we as retail traders could have access and you could actually trade in the overnight, but absolutely not recommended because of the volatility that you could observe there, or the low liquidity, depending whether there is some kind of event or not. Joseph is asking, who is controlling the supply and demand influences, or is it just random? So it's a very interesting question, Joseph. So I would give you a two-folded answer here. It's both random and it's both, controlled by big money. So why would we say that? Well, the smart money or the big money, the composite man, composite operator type of money will always be, uh, controlling the levels of the supply. They're going to consume supply, absorb supply, and then they're going to put it into the vault for the duration of the uptrend and not present it as a distributional supply throughout the uptrend. So in that sense, they will be controlling the supply and obviously providing the demand, and will be controlling the demand. Having said this, the price movement is still random from bar to bar. Somebody might come in and some money manager will have to raise cash, for whatever reasons that they have, whether this profit taken or, distributional raising of the money is due to, some of the withdrawals from the clients that they have, or maybe their methodology and models are showing that they're going to profit take here or completely close this position, but the price cycle is still going to continue already without their participation. Those type of behaviors are going to bring uncertainty to the market. So we can't really predict what exactly going to happen then on the next tick, on the next minute, in the next hour, on the next day. But we could definitely see, big money being in control of the bigger trends, and then, obviously on day to day, it's all random. And that's how I see this, and that's what makes sense to me in terms of how I interpret the market from that perspective. Very interesting question. All right, so let's do our first exercise. This is not going to be necessarily an exercise. I'm giving you a solution here. This is an example of bar by bar analysis. And I just want to go through this by myself first, and for you guys to follow my logic. So as I go through bar by bar, if you have a question, write bar number, let's say bar number 1, and then your question, and then I will know, what to refer to. Please don't go through this right now. This is for you for later references. I want you to just concentrate on my analysis. And this is, the tape reading is just a very unique skill. You can talk about it, you can listen to a presentation about it, but unless you actually do it yourself, you will probably not get it in depth. So as I go through this example, I want you to analyze each bar with me together. And this means that you have to concentrate on the chart and not on the solution. All right, and then we'll come back to the solution. All right, well, let's start with bar number one. This is our bar that is very interesting. And before we do anything, in terms of analyzing the actual single bar, and we're not analyzing the swings yet, right? So that's going to come in session number two. You need to define the bias background. Are we in the uptrend or are we in the downtrend? And let's have a pop quiz here. How do we define an uptrend? What would tell us that we are in the uptrend? What's the most simplistic way in technical analysis to define the uptrend? All right, all of you guys are so great. Wow, that's awesome. All of you are saying high highs, highs, lows, ascending structures, upsloping structures. Absolutely correct. So we see that here, and there was a question of how do we define the context. Well, in this case, this is as simple as this: higher highs, higher lows, and we see how the support areas are going up. We see how the resistance areas are also going up. Okay, so very good. And I see that a lot of you are paying attention, so thank you. So in this background, which is bullish, bar number one actually has an increasing spread and an extreme highest volume signature. So what do we actually suspect here? How do we interpret this bar? We are saying that the downward effort on this bar is increasing. And also the result is increasing. Why is the result increasing? Well, because the downward spread is increasing. We see this and we said that the spread is the difference between the high and the low. If we would look at the previous bars that are red bars, that are down bars, and now you kind of could see why I'm using the colors, because it's just much easier for me to go to those specific bars, and I could see how during the uptrend all of the reactionary bars were not that significant. And even if they were, there are some tails, which we're going to call demand tails, where the price is being marked up during the intraday action into the close. And that is usually bullish. Now, this is a different type of bar. This is what we're going to call is a change of character bar. It's completely different from what we've seen before on the extreme volume signature and on the extreme price spread. And also look at the last commitments to the upside, a series of up bars, and all of these closes are being negated by the close of bar number one. So what would we say about this bar? Well, this bar definitely looks bearish. And therefore, if this is a bearish bar, and if it acts as a change of character bar, we could expect some kind of reversal, which we've seen here, stop in action of the uptrend, and change of behavior, definitely seeing that, and maybe change of environment. From an uptrend now, we could go into a trading range. And look what we are doing here. We are in the trading range, for the duration of approximately 2 months or so. Actually, not 2 months. These are dailies, so I don't know how many bars are here, but yeah, so 22 bars, so a month time. Okay, next bar. The next bar is up. So how do we interpret that? There is an attempt to rally where the upward effort is increasing relative to war. Well, there is a zero bar right here that is an up bar as well. And we could see how the volume signature is increasing. So with that increase in price, do we have the increase in the result? Do we overcome the high of the previous bar? No. Do we increase the spread? Yes. So the bullish characteristics are increasing relative to bar number 0, but we can't overcome this significant bar, so the result is decreasing, and we are still bearish at this point of time. We are saying that because we are still bearish, we are expecting a continuation of the reaction. Orpheus is saying failed intention. Yes, the intention behind bar number 2 was to overcome bar number 1, and it didn't do so. so still bearish. Bar number 3 is very interesting because the effort on this bar is slightly decreasing than on bar number 1, but yet we are producing a much more favorable bullish result where we have a bullish tail and there is a rally into the close of that bar. So that tells us that in this volume signature, there is some presence of the demand. And if demand is present and increasing, we could suspect that there's going to be some kind of rally. Now, whenever we tape read, we have one rule, and this is probably Ramon's rule. This is probably like a pure Romanism, as my students would say. When we think about the change, we have to think that it takes time to produce a change. And therefore, we could see some signs of the demand coming into the market, but yet we could still be in the reaction here. So we're seeing some demand on bar number 3, and we're suspecting that the price should stabilize right here. But we could have still retests of the lows and even lower prices on the diminishing selling characteristics. So let's see if that is going to happen on bar number 4. So bar number 4 still has a relatively high volume signature. And now look at the spread. It's actually increasing over bar number 2. So we would be saying that the result on bar number 4 is increasing in terms of the increase of the spread and in terms of where the close is. But remember what we've talked about, the intention. What's the intention behind this bar? If there is so much effort, which is still a pretty high effort, to push the price down, what would we expect the price to do? Probably to go below the low of bar number 3 and to commit below it. Do we do it? Do we close below that level? No. And the reason why we don't do that is because demand became present on bar number 4. So our expectation is that we are actually bottoming because demand is present and demand right now is consuming supply. And at this point, we would be saying that we're seeing a potential stopping action in the volume and the price actions, and we are probably in the trading range with this type of boundaries. All right, well, let's see if we could find the confirmation that supply is actually deteriorating and that the demand is capable of maintaining the price at the same level. Bar number 5 has the intraday attempt to go up, and then supply comes in because we see that into the close there is some kind of selling. The volume signature is still high, but it's not as high as the previous bars. So therefore, we could conclude that the selling is actually diminishing even though supply is available. And by the position of the close, this is actually a very favorable result. Even though we're still in the reactionary mode, we're already seeing that the last 3 bars are changing the direction of the bias, or at least trying to change. First, demand comes on bar number 3, and it's available. Bar number 4 does not produce favorable result to the downside. And then bar number 5 is actually trying to rally. Supply comes in, but does not close below the close of bar number 4. So we know that demand is active in this area. What we need to find out now is where the demand could start pushing the price up and the price could go up with some kind of ease. So we look at bar number 6. Bar number 6 has diminished volume characteristics, so effort is decreasing relative to bar number 5. But what is the result doing? The result is actually much better. Why? Well, because first of all, we are closing at the high level. And secondly, our close is in the upper part of that bar. It's above 1/2 of the spread. So those two things are suggesting that now demand is becoming more in control, and there is on the diminishing volume characteristic some kind of ease of movement, which is bullish. And our expectation here is that we're going to continue with this rally, and we could potentially have some targets here where we would be expecting some stopping action, at least initially. So let's see what happens next. Bar number 7 kind of has the same characteristics. Volume signature goes down, but there is a progression from close to close. So there is again that ease of movement that is, the tape is showing us. Bar number 8 has a gap in the morning, and then the price continues going up, and then there is a supply tail. Why would supply come here at this level? Well, there is a resistance point right here, so therefore we would be expecting supply to come in. But what kind of supply does come in? Look at the volume signature. What can we say about this volume signature? Well, demand is most likely going down, and supply is going down at the same time. So even though some supply comes in, it is not very threatening supply, and it's only coming in because of this resistance right here. Rogan is asking, would bar number 6 be an entry point? Absolutely. This is a really good observation. So bar number 6 would be an entry point. Bar number 7 would be an entry point, and even bar number 8 would be an entry point if we have some kind of target somewhere here. And obviously, by entry point, I mean this is our first scale-in point of entry. This is our second scale-in point of entry. And this could be our third point of entry if we are scaling into the position. And the size of the third unit could be much lower than the previous 2 bars, because we are advancing further away from the point of risk, which is going to be bar number 5 and bar number 6. All right, well, supply came. Let's see, our expectation is that it's not going to produce a big reaction. Why? Because it's just there is not a lot of supply in this volume signature. And we are seeing this as a confirmation in bar number 9. Bar number 9 is the breakout bar of the local resistance. And it happens on this ever slightly increased volume signature. So demand kind of stays the same, and that pushes the price in a much better way. So we're seeing a better result. We see the commitment above the resistance. This is bullish and suggests continuation. Now the next bar, number 10, has the increased volume signature. So the downward effort is increasing relative to the bar number 9, but it's decreasing relative to the last instance where we actually had a downward bar. And this is a more complicated concept, so I'm not going to go into this a lot today. But you could compare bar number 10 to bar number 9. You can compare bar number 10 to bar number 8 because supply was here. You could compare bar number 10 to bar number 4 because the bar number 4 is the last downward bar that we have. So if we would be comparing it to bar number 4, what do we see? Is this a meaningful supply? No. Effort is decreasing significantly. Is this a meaningful result to the downside relative to bar number 4? No. Now the reactions are not happening in the same way as they happened on bar number 1 and bar number 4. So therefore, it's still bullish. And we still could expect a continuation of the price movement up. Why did we stop here? Well, again, the next level of the resistance, very logical place for us to stop where buyers stop buying and where sellers might come in and take some profit. So, and that's kind of like through the tape reading, bar by bar, you could see the logic of where the price stops or why the price stops at the specific levels. Bar number 11, we don't necessarily have the demand that would push us up, or with slight increase in the volume signature, we could say that maybe there is ever a slight increase in the supply, and somewhat ever slight increase in the demand that absorbs that supply. And after that, we should see whether there's going to be some kind of continuation. Well, before continuation, bar number 12 is again non-threatening, same level as bar number 9, and it is even smaller spread. So if there was some selling on bar number 10, bar number 12 is just non-existent, selling that doesn't produce any meaningful result. So it gives us a sense of timing that now the price should continue going up. In which manner it's going to continue going up? Bar number 13 obviously is one of the significant bars, and when we're comparing it to the previous bullish bar, which is bar number 11, you could also compare it as an analog to bar number 9. In case of bar number 11, slight decrease in the volume signature in the effort with the more profound increase in the result where the spread is increasing, where close is much more favorable, where we overcoming the resistance that was very significant for the duration of bars from 1 to 12. It shows to us that there is a breakout and an ease of movement, and we're still bullish. Next bar is very interesting, and I would still say actually bullish here still, and then bearish as a confirmation. So what do we see on bar number 14? Diminished effort to push the price up, and the spread diminishes. So we would say that this is a vulnerable place. It could produce some kind of reaction, but we're still bullish because even if we produce some kind of reaction like we did here, that reaction could be bullish. So what happens next after this vulnerability? Bar number 15. Well, this is where something changes. If we would look at the effort of bar number 15 and would compare it to the previous downward effort, which is bar number 12, we could see that the effort is just ever slightly less or somewhat the same. And yet, what do we see in terms of the result? We could see that the bar is, that the spread is expanding, that the close is somewhat bearish, and we are actually covering the body of the previous up bar. So on bar number 15, we see that the downward result is increasing, which is bearish. And after the indication of the vulnerability, with that increase of the effort and the result, we know that most likely we're going to go into the reaction. So you could see now how we've read through this whole swing up. And we first said at bar number 3, we have emergence of the demand. Bar number 4, less selling. Bar number 5, sustainability of the demand and less selling. Bar number 6 is the confirmation that now we're going to go up. Bar number 15 tells us that we are done with this upswing. And that's the beauty of the tape reading, is that it shows you the change in the behavior of the price action. And it suggests that we're not only going to change the behavior in the reverse, we're going to have an upswing, and then that upswing is going to end with its own change of behavior. So here is that change of behavior, and here's your trade. If you're a swing trader, this is it. All right, couple of questions. Could you say that demand is located above bar number 1 and bar number 14? Demand is available, that demand is located above bar number 1 and bar number 14. Well, because at the point, like before bar number 13 and before bar number 24, do we know that the demand is there? Well, perhaps, right? So if we, let's say from the low prices traveling up, we know that if there's going to be a breakout, like on bar number 13 and 24, there will be some demand. and some weak hands demand could be available. Some strong hands demand could be available as well, but we don't know for sure what kind of quality of the demand will be available. So therefore, we have to wait and see how the price actually unfolds and then make that type of judgment. Can you explain again why number 6 is a confirmation? Sure. So bar number 3 has an element of demand behind it. We see this in the tail. We see that in the high volume signature that suggests that demand is there and it's expanding. Bar number 4 on the diminished volume signature suggests that there is less selling. Bar number 5 produces stopping action for this whole reaction, but has some selling that doesn't produce for the first time a downward looking bar. So therefore, we know that with the relatively high volume signature, demand is becoming more in control. And as bar number 6 goes up and outperforms bar number 5 on smaller volume signature, we see the ease of movement with which the price moves up. And therefore, bar number 6 confirms that demand now is in control. All right, so what else? Bar number 16. Okay, Hamid, we have not covered that bar yet, so you gotta slow down, right? So we wanna go with the pace that we have. How would you time entry around bar number 9 and 12? Use stop buy orders. I'm often concerned about pin bars using buy or sell stop orders types from Jeremy. Okay, yeah, so some tactics here. Let's say that we're in this position with 3 units. We're probably going to be taking 1 unit off around the area of the resistance just, to have already a profitable trade and not to worry about this. Our stop loss is going to be below bar number 9. So our entry, and I like those type of entries on stop buy. Yeah, we could definitely buy on bar number 13 as additional unit, and then bar number 14 will produce some kind of hesitation, and bar number 15 will be our exits. So that would be our tactics. So these are kind of the trades that we could have. Okay, let's go forward. So now we said that bar number 15, is a change of character bar, and then perhaps the upswing is done. Well, we need to confirm that. Bar number 16, same type of effort, and there is an attempt to rally, but then there is a failure and slightly lower close. So that's a slightly more bearish bar than what we see from previous price action and suggest continuation. Bar number 17 is an attempt to rally. Look at the result of this rally. We see almost nothing there, both in the volume signature and the price action. So we know that bar number 17 is all about poor demand, and we could expect continuation of this reaction. Bar number 18 does not produce a lot of selling, but there is no buying either. So therefore, still continuation to the downside. Bar number 19, no emergence of the demand, so the price kind of falls down under its own weight. And bar number 19 is still bearish. Bar number 20 has somewhat of a promising attempt to stop the price from moving down because the volume signature slightly increases. But yet the result is still not favorable. So it's almost like what we've had here on bar number 3. There is some suggestion, a hint, that demand might be present, but we still don't have a meaningful demand, and still supply is in control. Bar number 21 kind of have the same definition of no lift. So we're still in the downtrend. And then bar number 22 is of very interesting to us in terms of where it occurs contextually, what kind of volume signature we have there, and what kind of price structure of that spread we have. So let's go through this one by one. The volume is increasing, and it's the highest volume signature in the last 5 days. So whenever we have that, and we kind of would say that this is a local volume spike, right? So because the price goes down, supply is increasing, we know that. But also we are going to say that demand is increasing as well because the volume spikes are like that. It's the presence of both forces, up and down. So therefore, we would be thinking that we might have some kind of stop in action, possible reversal, possible change of behavior, possible trading range, but we've been already in somewhat of a decline or reaction that is opposite for the definition of the bias itself. Also, please look where this bar occurs. The context of that is that we are testing the level of the resistance that we broke, and we are testing also the breakout bar number 13. And look at the volume signature of bar number 13 and look at the volume signature of all of the bars that come after that. Which is the strongest bar of them all, volume-wise? Obviously, bar number 13. And now we're seeing that there is some demand that is coming in at bar number 22. So we would be expecting a stop in action on this bar. And as a confirmation, we need to see a close above the high of that particular bar, preferably on the expanding volume signature that would suggest that demand indeed is expanding further and is in control. And we have exactly that. And that would suggest for us, overcoming of that level, the high of bar number 22, after the emergence of the demand, that this could be a very logical point of entry for us or an add-on. We also could add to the position at the point of the close if the close is favorable. If the close is above 1/2 of the spread, if the volume signature is expanded, suggesting an increase of the demand, and if the close is above the high of that lost commitment to the downside. Did you guys get this? Very interesting spot right here as it was here. So we're seeing that change of behavior and we are contextualizing the signal as to where it happens in the price structure. All right, well, if that is understood, then let me see one question here. Could a reaction to news create a false supply demand trading? From Joseph. Yeah, for sure. For instance, one of the false readings that we've just recently had in the market was the news about the stimulus package from Trump administration. The market reacted very sharply on the intraday level on Tuesday, 100 points on the S&P, and then after that we had a quick reversal up just because the news turned around. Bar number 16, what about it? I mean, I think that we've talked about this. Same effort, and then we are trying to rally, but we can't. So with that effort, that is a suggestion that supply is still present, and that is the suggestion of the continuation. That's our interpretation of bar number 16. Higher effort but barely down move. Well, you should be thinking here what is happening intraday, right? So from this low, what is happening first or when the market opens? Is there a rally? I mean, if we would expand this a little bit, right? So from the previous close, we are opening slightly up, and most likely we are rallying. And then as the rally fails, we're going down, and then we're closing like this. So what kind of day do we have on the same type of effort? As we attempt to go up, supply increases, comes in, and that pushes the price down. So bullish or bearish? Bearish. It's not that it acts bullish. No. It's trying to act bullish. It has an attempt to rally, but it fails. So it's not acting bullish, it's acting bearish. It looks bearish and it acts bearish. All right, next, bar number 24. Slightly smaller volume signature, but the expansion of the spread, so ease of movement on bar number 24, and we're still bullish. Bar number 25, there is some kind of vulnerability just because the volume signature increases, and we could be expecting maybe there's going to be some kind of reaction to the support level, or we're just going to overcome this level, which we do on bar number 26. And bar number 26 comes on the diminishing volume character. So again, we are producing some kind of ease of movement as the price goes up. As long as the supply does not come, or it comes and it's being observed, then we definitely, most definitely, will be thinking that demand is still in the control. All right, so bar number 27, again, we are producing some kind of vulnerability because the volume signature diminishes and the spread is diminishing as well. We are expecting some kind of reaction, but we are still in the bullish mode. We need to see what kind of reaction we're going to have. Are we going to produce a bar number like bar number 15 or bar number 1, where supply is most evident? Then we would be saying that indeed the reaction is taking place, and more meaningful reaction is taking place, and then therefore it could be something of a meaningful reaction, and we would have to think about our trading decisions to get out of the position, to decrease, and so on and so forth. Bar number 28 adds more to the vulnerability. The volume signature increases and the result to the upside decreases. We should be expecting some kind of reaction. And as we go here, so bar number 28, let me just quickly see. Analog bar with bar number 15. Okay, well, let's look at this. Number 28 and number 15. Why those analog bars? Well, because we are in the upswing and we're concluding this upswing and at 14, and we're thinking that we might conclude it at 28 as well. Bar number 15 relative to bar number 28 has somewhat of the same effort behind it, and yet what is the result? Bar number 15 is expanding more to the downside than bar number 28. Just based on that alone, we could say that we probably would be expecting a reaction of lesser degree than what we've had from 15 to 22. And that's kind of like a beauty of tape reading, that we could go through the logic of reading the chart, of reading the tape, and we could deduct as to what kind of character potentially we could have for the next move. All right, so bar number 29, increased volume signature, and this is the highest volume signature since bar number 8 or 9. And with that, we have a demand tail, and the close is very close to the previous closes, or to the previous 3 closes. So that is suggestive that demand is present, and it's absorbing whatever supply has become available on bar number 27 and 28. So therefore, our expectation is that reaction is not going to be deep, demand is coming in, and most likely with this type of price action where we are not giving up any ground, we're probably just going to continue up. And again, how valuable this information is for us at this spot, because the amateuristic trader is going to be thinking that there is a diminished momentum characteristics, which is true, and then some supply is coming in, which is true, and not truly thinking about what result is and what kind of character of the result we have in these 2 bars. Would be probably thinking that there is a need to close a position here because expectation is for a much deeper reaction. Bar number 30 basically confirms everything what we've seen in the last 4 bars. Supply coming in, demand is capable of absorbing the supply, and the price is holding at this level. continuation. And the volume signature somewhat is diminishing relative to 29, 28, and is slightly higher than the previous up bar. So a very healthy bullish continuation. 31 is a healthy bullish continuation because the volume is expanding and price is still going up. 32 produces an uncomfortable uh, situation for us because of the volume increase. This is the highest volume since the initial reaction where we started our analysis. So let's look at those volume bars that we have and correspond them to the price action. Bar number 4, look at the spread, look at the close. Bar number 1, look at the spread, look at the close. And bar number 32. What is more bullish? Bar number 32 or bar number 1 and 4? 32, of course. Thank you, guys. Why? Well, because the close is not at the low of the spread, and the spread itself is not as large as those 1 and 4 bars. And look at where we are closing relative to the previous close, right? So this is the progress to the downside, close to close. This is the progress to the downside, close to close, for bar number 4 and 1. There is a huge difference there. So even though we see that supply is coming in, but we always question what kind of result do we have. The intention behind this bar is to overcome the low of bar number 31. We are not even near that. And I like this comment by Hamid. He's saying maybe this is a preliminary supply. This could be, right? So supply is coming in, and we know that preliminary supply will always fail, and the price will still advance to the upside. Okay, bar number 33 is basically what David Weiss calls this bar is a resurrection bar, and I like that definition a lot. Started using this, in classes with the references to David. It basically shows that whatever supply has come in, it's been absorbed on bar number 32 itself, and now with the increased volume signature, it's also being absorbed in bar number 33, and it's a favorable close relative to the previous close, and we are very close to the high of bar number 32, still bullish. Next bar to the downside confirms that supply is no longer in control from bar number 32, and we are closing at the higher level, so which suggests again a continuation, which happens on bar number 35. Not necessarily a breakout that we would be expecting on the slightly diminishing volume signature and a diminishing result, but it's not bearish either. It's vulnerable to a reaction, but we should see maybe there's going to be a continuation to the upside, which we do have. And bar number 36 is interesting that the effort is actually decreasing, but the result is better than bar number 35. So an ease of movement is present, and we're still in the uptrend at this point of time. Next bar number 37, is a small spread relative to bar number 36, and we are increasing the volume signature. With that, with the diminished result characteristics, that suggests that there is some presence of supply, and therefore we are somewhat vulnerable but still bullish. Bar number 38 reminds me of bar number 32, where we have the same type of price structure of the spread and the same almost equal amount of the volume signature. So the effort is the same and the result almost the same. We are still in the vulnerable position here, but we are still bullish. And I want you guys to see in my notes that my notes are reflective of how change happens. It's gradual. It could be very dynamically fast, right? If we have a lot of volatility. But it could be also very gradual from bar to bar. There is some selling that's coming in, but it's not as strong. It could be still observed on the excitement, let's say by weekends, and there is still some buying that's going to push the price up. And this is what we're seeing in both bars number 32 and 38. Vulnerable, but still bullish. Okay, bar number 39. Increased volume signature relative to the previous bar, which is 37, and then look at the result. We're closing lower, and the close relative to the position of the close in the spread is much worse than bar number 37. So therefore, we've seen some kind of, again, continuation of that vulnerability, but the intention was to overcome specific levels, and we don't do that, so we're still bullish. And the last bar in this exercise here is bar number 40. We are diminishing effort and yet still going up, so there is some kind of ease of movement on the lower demand, so still bullish. We still have not produced the synchronicity between the increased downward effort and increased downward result for us to say that we are done with this particular swing or this particular trade. Now let's retrace our steps a little bit. Bar number 6, a confirmatory bar that the upswing is starting. Bar number 15 is a change of behavior bar. So here's our swing number 1. Bar number 22 suggested that there is a demand, and the confirmation comes on bar number 23. So here's your next swing. And then we are currently still, even though vulnerable, but still in the upswing. You could literally tape read and trade like this. Yes, it's very laborious. As you could see, there is a lot of work here, and you have to analyze one bar at a time. But at the same time, these are daily bars, so they come every 24 hours. And I'm sure that in 24 hours, you could find the time to analyze one bar if you're, let's say, following the market or following a specific stock or the futures. And you could do this. You could probably follow all of your positions and analyze them like this on the daily basis. Now, when it becomes a routine and you just go through this exercise over and over each day on multiple assets that you have, not only is going to become easier for you to interpret, you're going to understand a better, you're going to understand better how the price moves, the character with which the price moves. And you will be much more accurate in terms of your entries and exits, and your stop losses are going to be moved more logically, and your exits are going to be more logical as well. All right, let's quickly see some of the questions here. Okay, some of the repeats. So what's the intention behind bar number 6? Okay, so because this is a bullish bar, we want to overcome some specific levels of the resistance to the upside, right? So what are those? Obviously, the high of the previous bar and the close of the previous bar. So we're overcoming the close. What else? Bar number 24 could be interpreted as intention was served but spread diminished. How to interpret and weight these opposing findings from Iqbal? Well, this is still an relatively ease of movement, right? So we overcome a meaningful resistance, but this bar is not contracting like bar number, let's say 27 or bar number 37. We probably did somewhat the same at bar number 9, somewhat the same at bar number 13. So we're committing above, and the volume signature here is still relatively high. So you should be thinking here that there is a presence of the demand. So therefore, intention is still satisfied. I agree, Brian. Yeah, so bar number 15 and 28, very subtle comparison, but at the same time, it's a very proper comparison because those are the analogs. This is where momentum diminishes, and our expectation after this vulnerability is that there's going to be a reaction. But then, obviously, looking at how this area unfolds, we could deduct that the reaction is not going to be of the same magnitude. Good observation. Cheyenne is asking, bar number 30, would we be adding to this position here a close or break of bar number 29? Absolutely. This is a really good spot. Why? Because as supply comes and we see a resolution of that emergence of the supply, that automatically suggests continuation and the add-on that we could do. So absolutely good observation, Cheyenne. Okay, was the intention of bar number 33 to close above the resistance of bar number 32? Again, you could think about multiple points of the resistance here, right? So obviously the high, the open, the close itself. So we are overcoming also the previous bar number 31 high. And more importantly, after bar number 32 supply, we don't have any follow through to the downside, and we are still resurrecting to the upside. So looks bullish more than bearish. All right. Ming is asking, with backing up action, would you call the intention to penetrate the trading range and judge based on the lack of the supply, or would you call it weak bullish volume that makes the rally vulnerable, or both? So we're probably talking about this, specifically bar number 13 or bar number 24. So 13 does not have that, strong volume signature, strong demand. And in a way, because of that, we have this reaction. So the logic just, kind of like very fluid in this assumption that because the breakout was not on the expanding volume signature, but still relatively higher. I mean, if we would be thinking about, let's say, these two bars right here or bar number 9, and we would be comparing them to the volume signature at 13, there is some expansion in the demand just relative to what we've seen before here. We could say probably the same about bar number 17 and the breakout at 23, 24, slightly higher. But the way how the commitment happens, right? So there is a relatively big progress of the resistance line itself, and 24 kind of has the same type of the characteristics. So that is suggestive, still of uh, some kind of vulnerability that could come later on, whether temporary or more pronounced. And yet, there is a commitment, which is very clear. After bar number 23, there is no backing up action. Is there any way to predict that? Well, we are actually, we could, and this is a little bit more advanced. So for those of you who are not familiar with this, we could look at this as an upslope in trading range, right? So this is what we're studying in the WTC. Phase C, sign of strength. Oh boy, is there a backing up action? Or not? If you look at that from that perspective, then you could definitely find that. And then you also could look at, let's say, intraday, smaller trading ranges, right? So somewhere here, there could be a backing up action. It's just hidden behind the intraday action. All right, what else? Oh my gosh, so many questions. All right, guys. Let's move on. Save your questions for next time when we're gonna go through some of the questions. Let's go through the material. We actually at 5 o'clock, so we'll definitely go to 5:30. And for those of you who can't continue with this session, we're gonna have the recording for you tonight, so you could watch it later tonight if you're, want to go and watch it into the night, or you could do it later on. Okay, we're gonna skip this exercise number one. I think that we're gonna go to our material and see how many exercises I have for you actually. Okay, so contextualizing bar by bar tape reading. And this is the key here. Context is the king, actually, in a lot of things in life. So as we go through, we've ended up right here on this bar. This was the last bar that we've analyzed. So what happens next? And we would have to go through this exercise, but we just don't have time. So let's just stick to the ideas here. We need to understand the background of what is going on. And we were saying that the uh, background was bullish for us as we were analyzing these moves to the upside. Now, something happens after we register the high here. What happens? Well, if we would look here, these two bars on the increased volume signature are a change of behavior bars, change of character bars, just because everything else before does not have that type of structure of the spread, that type of expansion of the spread, and supply is increasing at the same time. So we could expect that this swing up is done, and this would serve us as an exit. And look how subtle that is. Look how subtle that is before a big major move move down. So you have to be on the lookout, and you have to understand, where we are in the context of this whole uptrend. And this is a little bit more complex picture because this is a more of the intermediate type of climactic run that we have had here. So we would be expecting a more meaningful reaction. But as we change the behavior and we can't rally on the next two bars, that is suggestive of the continuation of the move to the downside. Well, from here, we could conclude a couple of things. Well, first of all, and I didn't put it here, a stopping action, a climactic action. So we are trying now to define the context of the environment and the context of, let's say, a trading range here as the price unfolds and it shows more of the range-bound action. So a most definitive change of character bar suggests a change of environment from an uptrend, bullish, to more of a trading range and to the short-term bearish, just because a change of behavior is still unfolding. The next bar looks like a climactic bar, so suggesting a stopping action that's going to define some kind of level of the support, and that level of the support is being defined actually on the next bar as we first go down and then we go up. And then further down the road, we see the bar that tests the climactic action, and we would say that this is probably a secondary test bar that is confirming stopping action. And right away here, we could define the boundaries between the buying climax and the climactic stopping action and the secondary test. And we're probably thinking that we are in the trading range as just a much larger trading range. So our expectation here, if this is a trading range, is that we are gonna have some kind of rally to the upper boundary of the trading range, to the resistance, and we're gonna have some kind of reversal pattern that could come as a lower high or a higher high. And if this is a higher high, then this is an upthrust in the trading range. And the way how we would capture that upthrust is with the reversal of the last commitment to the upside, where supply signature is going to start increasing. We're going to start seeing increase of the spread, and then we're going to see a change of character bar that would suggest that we are done with this swing completely, and now we are coming back into the trading range, and this is the whole structure. Now, why do we need this? Again, why is the context so important? because the VSA signals that we are going through here, bar by bar, is actually would be interpreted somewhat differently. And also, we could use the analog bars. We would compare, let's say, the behavior of the price at the points of the resistance, the behavior of the price at the points of the support, the behavior of the price somewhere around the local breakouts to the upside and to the downside. And that would give us some valuable information what is to come next and what is also the character of the next potential move. All right. So in the analysis sequence, what I would like you to do, or how I would like you to think about how you analyze, I want you to define the current environment, whether it's trending or a consolidating environment. Then I want you to define that Wyckoff price structure. If this is a consolidation, Wyckoff events and phases. If this is an uptrend or a downtrend, what kind of a phase of the uptrend or a downtrend we are in. And then, only then, start applying the tape reading techniques. Bar by bar, then swing by swing, then look at the analogs. And only after that, make your final deductions as to the bias, the timing, and the character of the next move. All right, great. Let's go to another piece of material before we go into the next exercise. Let's talk about the analog bars comparison. And why would we even do that? Well, students always ask me, what's this elusive character that you talk about? You always say, we need to define the character of the next move. Well, imagine if we would know that the next move is going to be a very quick momentum move that has some kind of verticality built into it. Would we behave differently in terms of our trading? Would we put more size? Would we use other instruments? If we're using, let's say, other instruments like options, what kind of expiration would we have? What kind of strike price would we choose? So there is a lot of trading decisions based on the definition of the character. And when we are using the analog bars comparison, we could extract that information and deduce what kind of strength or weakness we have on a specific bar. All right, so here is an example of this. Again, we're looking at the same sequence here. And don't worry about the solution, right? So some of you are asking, will we have the slides that we skip to review by ourselves? So it comes from Alex. Yes, absolutely. I'm going to give you those, or I'm going to just see if we could still use this as an exercise in the next class. So what is going on here in terms of the analogs? How do we define the analogs bars? So I was thinking about the definition. So here's the definition that I'm going to give you today. Those are the bars that happen at the comparable price structural spot. So for instance, if we're looking at the bars that happen close to the resistance and that are at the end of the climactic run or at the end of the upswing, those could be our analog bars because they happen at the comparable price structural spot. But they also, we would like to see similar price, volume, and momentum characteristics. So for instance, we could see how the volume signature is somewhat the same on these bars. It shows diminishing demand characteristics in the climactic run, and it suggests that we are close to the top. We're close to the top. It might not be the actual top, right? So in both cases, we have the intraday top here, we have the close here, and the intraday top right here. But these bars are comparable. And if they are comparable, we could probably make some kind of deduction as to the strength or the weakness of what comes next. Well, obviously, as we are expecting a reaction, how would we make a judgment of the strength of the weakness of the next reaction? Well, we could see that probably bar number 2 here is holding much better, and it's looking much better. It has a gap up. This spread is somewhat better in expanding, and we are closing at a slightly higher ground above the analog bar number 1. So we're thinking that if we are going to have a fully developed reaction, this reaction is going to be somewhat more bullish. And this more bullishness in the reaction could be shown to us in the character with which the price moves down, meaning that maybe the spread to the downside is not going to be as aggressive as we've seen before. Maybe the extent of this reaction is going to be less and we're going to create a higher low. Maybe the volume signature is not going to be as high as we've seen on the previous reaction. And therefore, again, it's a valuable information for us to use in order for us to, to trade this reaction. Okay, well, let's look at another analog. We see a change of character analog on the change of character bar. So here is one and here is another. So the reactions and the rallies are always going to develop in the same way, where the change of behavior happens. Almost the same sequence is going to be present, right? So here's the expansion of the spread, expansion of the spread, expansion of the volume, expansion of the volume. So we see a slightly less volume character, so slightly less effort to push the price down. We also see that the close is more favorable in the second instance than the first one. So this is suggesting that demand is present here. So therefore, again, would the reaction number 2 be somewhat more bullish or less bullish? Obviously, more bullish. And again, from here, we are concluding, that we could be creating a higher low, that the character of the down move is not going to be as dramatic as we've seen on the first reaction, and that's exactly what happens. Next bar that we could compare, a climactic analog bars. Okay, well, here is one volume signature. Here is a series of 2 bars with kind of the same volume signature with the same effort. Now, what happens here? We're combining 2 bars. So spread-wise, it seems to me that they are somewhat the same. I could only make a distinction, maybe a slight distinction in the position of the closes. So a slightly higher low close, but we knew that the climactic action, because of the character and the strength of these analog bars, are going to be somewhat better. It's probably going to come on a higher low, and that's exactly what happens here. Higher low also suggests a bullish bias after the stopping action, so we kind of given a bullish bias to this whole formation right here. Okay, so what's next? Testing bars of the climactic action. So we see continuation to the lower low. We see a continuation to the lower low again. It's just a lot of momentum in both of the reactions, so they just go drastically down to the lower lows, kind of reminiscent of what we have had just recently in COVID reaction. We want to see diminished supply characteristics, and we see those. And look at how close all of these analog bars in terms of the volume signature is just uncanny, right? So, but we know that the second reaction is somewhat more bullish. So again, it's the position of the close that is different. It's also the spread itself, somewhat smaller. And again, not only that we could conclude that this is more bullish, and it's kind of funny how we think about the reaction, that the reaction could be more bullish or more bearish, but I want you to think in those terms. Why? Because if the reaction is more bullish, there is definitely an expectation that we might actually have a more bullish rally after that. And if it's more bullish rally, we would be thinking that we could overcome this high. into maybe like an upthrust sign of strength type of movement. So everything what we see on the chart is very logical because we could make a judgment of what's to come based on the price action and volume action that came before. Last one, an upward effort of the test low. So off this low right here, off this low right here. And we're seeing how this bar right here uh, somewhat more favorable in terms of how that rally off the test happens, right? It requires more effort to produce the result that is going into one half of the test bar. So we probably again thinking here there is more ease with which the demand moves the price up. So what conclusion would we make out of that? Most likely that we're going to have the expansion of the movement up, and we're probably going to make a high here. If we're going to do that, then our trading tactics are going to be, somewhat different. All right, guys. So this is, I thought, was kind of like a really good example on the analog bars, and specifically in the trading range. You want to do that as the trading range unfolds. You want to do that in the uptrend, comparing, different parts of the swings and different swings, and then also in the downtrend, you could do the same. Okay, so I'm going to assume that we're going to go until 5:30, so we have 15 minutes left. First of all, let me show you your homework. So your homework, actually, let me think about this for a second. Yeah, I'm going to give you a different homework. All right, so let's definitely, and your homework is not going to be about like define the bias. That's not what we are doing here. Your homework is going to be just to go through everything bar by bar. So that's what we're going to do. All right, so let's come back really quickly and let's just see. Yeah, so we stopped here on exercise number 1. Yeah, 15 minutes is not going to do it, but let's just try. Okay. And so I'm not going to ask you questions, or maybe I will, so you just have to kind of like see. All right, bar number 1 and bar number 2. Definitely a change of behavior from what we've seen on all of the bars to the upside that are down. We know that we are done with this upswing. And at this point, this vulnerability, only needs to be confirmed by a poor demand, which comes on bar number 3, and which comes partially on the intraday on bar number 4. Bar number 4 has somewhat of an ease of movement to the downside, so therefore that is a point of entry, and that is the suggestion that we're going to go down in a more meaningful way. Bar number 5 negates everything about the uptrend that we have had concluded before. It's just the expansion of the spread is so significant that it just basically says, I'm done, I'm in a new environment, you should be closing your positions if you haven't done so before here. And then that leads to the climactic bar number 6, which has the massive climactic volume signature. Behind that is the hidden demand increase, which suggests a stop in action. And again, stop in action and change in itself happens gradually. It might happen very quickly, but usually it takes time. Why? Because as supply is increasing and demand is decreasing, it's a collision between these two forces. And it takes time to absorb all of the supply by the demand. And so it might take several days or even several weeks, to stop the price from moving further down, depending on how everything unfolds. Bar number 7 has that intraday move down, and then look at where we close. We're closing at the upper part of the spread, and we're overcoming 1/2 of the bar number 6. And we're doing this on the relatively high volume signature that suggests that demand now is expanding at the exponential rate relative to what we've seen before. And now it's producing the result to the upside. Great. So this looks like a change of behavior relative to the move to the downside that we've had, and it suggests some kind of trading range or a consolidation. With this trading range right here, we're also thinking that there should be a test of the climactic action. So here we go, bar number 8. We have somewhat of a potential reversal. Volume is going down. There is no continuation to the upside. So there is some kind of vulnerability for bar number 8. Bar number 9 increases in volume signature. And because we are testing the climactic action, bar number 9 should be compared to bar number 6. And we could see that the downward effort is decreasing as the volume signature goes down. And we also see that the spread is decreasing. And we're also seeing that the progress from close to close is showing to us shortening of the thrust. If from close of bar number 5 to close of bar number 6, we have a good progression to the downside, we do not have that either from 8 to 9 or from 6 to 9. So there is that shortening of the thrust, shortening of the momentum to the downside on the volume signature that says that there is less selling at this point. So we are truly in some kind of secondary test attempt, which is starting to be confirmed by bar number 10, where we see the volume increase, which suggests the increase in the demand. And we are coming with the demand tail, and we are closing favorably as well. Bar number 11, if we would have had supply still present, bar number 11 would go down, but yet we have no follow through to the downside, and on highly diminished volume characteristics, this is where we would say that supply is exhausted and demand after the exhaustion is capable of pushing the price up with ease. Bar number 12 creates some kind of vulnerability where could expect some kind of reaction here, maybe a reaction to the downside. Instead, that reaction is only on the intraday level, and bar number 13 on the increased volume signature, on the increased demand, breaks out this local resistance, breaks out above bar number 9 high, breaks out above the highs of the previous couple of bars, and suggests that the demand is in control at this point of time. Bar number 14 is just an ease of movement and continuation to the upside. Bar number 15 is, as we've shown before in this similar situation, has some supply, which is less than what we've seen on any of the previous declines. And that still suggests vulnerability, but in a bullish context, that we are going to have a reaction. But most likely, that vulnerability is going to go away. Well, where would we see that vulnerability going away? It's probably after bar number 18, where not just the spread is increasing relative to bar number 16, it's better close, and the volume signature is somewhat the same. So we're producing a better result on the local spring than bar number 16. And that suggests the timing for the continuation of the rally. Continuation of the rally happens, and bar number 20, reminiscent to bar number 0, this is where volume signature diminishes, and we are seeing that in the area of the resistance, again, context, think about where the signal comes, diminished demand characteristics, we could expect some kind of appearance of the supply just because demand is now more vulnerable. Supply comes in at 21, slight increase, and look right away how it produces a much better reaction that what we've seen before of the low of bar number 10. And that suggests a reaction. Where would we go? Well, obvious points of interest for us is the cluster of support between 14 and 18, and that's exactly in the bullish scenario where the price would go. We see that 22 has an attempt to go up and then failure into the close on the same relatively high volume signature, so still continuation to the downside. Bar number 23 is so interesting because the volume signature is close to what we've seen before. So it's kind of suggestive that the weak hands are giving up on this position here because they don't want to be caught up in the movement like we've seen before. So obviously from here, as they give up, big hands are going to come in and they're going to buy. And we see that in the increase in the volume signature, that is suggestive that demand is present there. We also see this in the demand tail. But because there is some significant selling that is happening on bar number 23, the next move is still to the downside on the intraday basis, and then recovery on the next day on the relatively high volume signature. So again, presence of demand and suggestion of the continuation. Now, if we're going to continue, not only we're going to test this high, we're probably going to test this high as well, and we might overcome this high just because there is an absorption at this level. And let's see what happens. I mean, obviously, 26 has some kind of vulnerability, again, on the diminished volume character and diminished spread. And that produces intraday reaction at 27, but 27 has emergence of the demand, and the close is favorable, the close is highest in the last 6 days or so. 28 ease of movement, 29 even more ease of movement, but as we've discussed before, and it was evident, ease of movement is favorable for the continuation unless you're gonna start having supply coming in on these diminished demand characteristics. So we're seeing diminished demand characteristics through the last leg up into the up thrust condition. We said that contextually we probably in some kind of trading range. So momentum is slowing down, demand is diminishing, and then on bar number 31, what happens? Supply is starting to come in. And that's vulnerability turning into a bearish reversal on bar number 31. To confirm this bearish reversal, we want to see an ability of the demand, like we've seen it here in this area, to try to rally and to fail. And we do. And bar number 35 becomes a very bearish bar on the expansion of the result to the downside. So here is another exercise for you. All right, guys. So I'm gonna give you a different exercise as a homework that I thought that I would give you just because we haven't gone through this. I want you to analyze the next sequence. And here it is. Okay, hold on a second. Okay. Yes, so I'm going to give you 3 slides. So here's the solution here. When you do this exercise, I don't want you to look at the solution. So, be honest to yourself, first of all, and don't look at the solution. Try to go through all of these bars, bar by bar, and do the same type of the analysis, and only then compare it to my notes. I might have some mistakes here because I was working, really hard through the last, 2 or 3 days to put this material together. And there is a lot of details here. So if you find the mistake, let me know. I would gladly look at that. And if you're correct, I'll correct my mistake. So I'm going to give you 3 charts. This chart right here. this chart right here, and this doesn't have a solution, so this is more appropriate for the homework, and this is just a continuation of the same price sequence. And then this chart. So you will have to analyze 40, 41, so that's 81, and 35, so that's going to be what? 116 bars. So pace yourself, because 116 bars, you will have to sit down and at least have, I don't know, maybe a couple of hours for sure. And that would be your homework. Go bar by bar, analyze each bar, compare those bars to either the previous bars of the same bias, or maybe you're gonna find some analog bars, compare those to those bars, and then obviously we'll review the solution, and it's probably going to be self-review as the solution for the next time. Questions, comments. Let me just see some of the questions that we have here on this exercise. Okay. Okay, Leonardo is saying, we don't know if bar number 2, am I reading this correctly, Leonardo? Bar number 2 is the climactic analog. I would see it as an ease of movement bar. So I'm not sure what is going on here. It was on the first slides. Okay, so yeah, let's just discuss the questions from the slides. Okay. There was 3 bear bars after the first bounce of the downtrend from C-Shan, and the last bar had a large volume spike. Are we discussing this, guys, still? C-Shan, are we talking about this slide? Let me know. Yes, 23. Okay, so bar number 23? Is that the bar, C-Shan? All right. Okay, so there were 3 bear bars after the first bounce of the downtrend, and the last bar had a large volume spike. Would this be considered a change of character at the moment of happening? So how would we view this bar? The downward pressure is increasing relative to bar number 22, and the result is increasing as well. So our simplistic interpretation of that is that it's a bearish bar. But as we know, and as we've talked about, volume spikes are going to have this type of the equation where supply is in control and is increasing, but there is a presence of demand and it's increasing as well. This bar is going to suggest stopping action, suggest a change of behavior to come, suggest some kind of reversal to come, suggest maybe a trading range environment. Bar number 24 confirms that demand is present, and now demand could push the price up, and bar number 25 confirms that now supply is not in control and demand on smaller effort could push the price up. So it's a sequence of confirmation. It's not necessarily a specific bar. You could have different levels of the confirmations that could come confirming that demand is present. Demand is present here, and that acts, this acts as a confirmation, having a tail on the level of the support with the increase in volume signature. Next confirmation, bar number 24, the demand is present, increasing, and could push the price up. Number 25, there is no need for extra demand because supply is not in control. Okay, Franz is asking, if we want to enter on the test, then setting a limit buy below the low of bar number 7. So where are we entering on the test? So, yeah, sure. I would definitely consider that. These two levels, one and two. I think, Franz, that it's logical here to use the climactic law because if we're gonna travel even just to the heights of the trading range, then the climactic action could act as a logical place, to place the stop loss. Okay, next one from Jeremy. How do you see the reaction at 21, 22 compared to 1 and 2? And I think that we've talked about this a little bit, right? So um, look at the volume signature. So here, the volume signature, somewhat comparable, but I would say that it's interesting how, uh, we have selling off the top, and bar number two here actually has a little bit more selling than bar number one. We would be thinking here that comparing just the spread, that maybe this reaction could be a little bit more significant. And obviously, when we make this type of assumption on the what kind of reaction we're going to have, we also have to wait and see what actually happens. Because as demand comes in around this area, we could stop that movement down. We could stop that reaction. And actually, I've seen this mistake just recently, this Tuesday in the practicum, where our students were thinking about the synchronicity with which the effort increases and the price goes down. And then they were expecting a much more meaningful reaction, and it didn't come. Why? Well, because if demand comes in and absorbs the supply, it's going to stop that movement. Do we have the emergence of demand on the next bars, on 4 and 5? No. If anything, supply is in control and increasing, and therefore suggests a continuation. But this is a really good catch, Jeremy. So, kudos to you for seeing that. Sam is asking, would the last commitment to the upside bar would be bar number 30 or 29? Technically, the last close is the commitment up, but the commitment of the significant bar obviously will be bar number 29. Okay. All right. I think that's it. All right, guys. Somebody was asking to show the 40 bar exercise again, Chandra. Okay, sure. Let me just go there, and then we'll conclude this session. Okay, so here is your homework. 41 bars, 40 bars here. Okay, so what are you guys supposed to do? Well, first of all, lots of material here. So your homework number one is maybe to re-watch this session. Excuse me. Second assignment, you're gonna have 116 bars to analyze. So I'm gonna put this in a separate file as a homework, and this is gonna be a PowerPoint file. So you could just, have those definitions of the effort and the result, and what do you think this bar is, bullish or bearish, and just write those down, and that's your homework. In the next class, we're going to be discussing swing analysis. So bar by bar is very meticulous, in terms of how much we have to think about each bar, what bars are we going to be comparing. Swing analysis is going to be somewhat easier, but also a little bit more elusive, because you will have to think in the context of the whole swing up or down, and how do we compare those to each other. based on the context of the environment that we are in. But obviously also a lot of fun. Okay, well, hopefully a good start for us. I'm feeling excited and still psyched, that we went through such a big body of the material and we've done a lot of the exercises. Don't be lazy and actually do the work. Print out the homework and actually go through the chart bar by bar. Do yourself a favor. Don't waste your money just listening to me. I can do this analysis because I'm doing it every day, and you guys have seen me do this, in so many classes. I want to push you to do this. Even 30 minutes of exercise like this, or where I'm giving you the chart, I'm going to give you the solution. Please do so and, improve your skills. All right, guys. Well, with that, that's it for today. I'm going to see you next Thursday. Have a wonderful weekend and a happy trading. Thank you, guys. Bye bye.